President and CFO at Cholamandalam Investment and Finance, to talk to us about the numbers that Chola has posted. Of course, a soft day for NBFCs in general and Chola following suit. But Mr. Selvan, great speaking with you. Let me first start off with the 15 basis point improvement in margin levels H2 versus H1, which you all were penciling in. There's already been a 10 basis point improvement. Talk to us as to whether the 15 basis points for full year FY26 or for H2 and where should the full year basically NIM lie? Give us a sense of that.
We still hold that. I think we will still reach there given the cost of funds drop that is progressively happening. And we should not be too far from that mark.
And guidance for margins Q4 FY26, if you can give us some color.
See, we closed the current quarter at 8%. I think we should be at the similar level, maybe a 5 BP movement upwards. Primarily because, as you see, there is a lot of volatility in the market on the benchmarked pricing. So I just want to be a little bit conservative about it while we could still improve beyond that.
And what's the status with regard to credit costs, sir?
The total loan loss to average asset should be in the range of around 1.6% for the full year. We had this quarter, we had done an asset sale. So that is why the ratio seems to be marginally higher or similar. The expected reduction is not visible, primarily because of that. But I think in the Q4, you will see this reduction more visible.
Right, and credit losses in the CSEL business are expected to have peaked and are expected to, in fact, moderate. Talk to us about improvement or the status with regard to progress on that.
You're right, it has peaked, but I think it will be there for one more quarter. If you look at our earlier narrative also, that we said it will be running down more in FY27 from Q1 itself, because a large part of the book, which is a 1 year old book, will completely run down by Q4 of this year. So we should come down. We should see little at similar levels, not elevated beyond these levels, but it will still be slightly higher than what it will happen, going to happen in Q1, Q2 of subsequent year.
Yeah, and NPA ratios, they've inched higher. What's playing out?
Primarily, this is, a large part still continues to be because of the unsecured book, which is running to its peak. But also, there is a little bit of a higher or elevated NPA numbers in the vehicle finance. We expect this to come down in Q4, and we should see them, trending to be lower in the coming quarters. It may again go up a bit in Q1, which is the normal trend in any financial year, where Q1 and Q2s are a little higher stress for vehicle finance. But then next year, Q3, Q4, it should come down, more substantially in line with the earlier years.
And apart from the vehicle finance book, are you seeing stress or early stress signs anywhere else? You spoke about unsecured as well.
No, other than we already spoke about the consumer and small enterprises thing, which is the unsecured book, that should come down in the subsequent year, that is FY27. And in the rest of the book, we don't see any large stress, and we are comfortable in those businesses.
And the interesting piece is that we are in a rate cutting cycle. So if rates were to go down, what's the margin benefit that can continue to flow through, or will you pass on that benefit to your customers?
See, if you look at our borrowings, 50% of our borrowings are from banks and 50% is from market. Now, the market borrowings are mostly fixed rates, so they will not immediately show the benefit, while it will show the benefit in the as we move into replacing them. With regard to the bank borrowings, 50% of the 50%, which is around 25 to 30%, is benchmark with regard to repo rates or T-bills, etc. So they will show the immediate benefit and that would get passed on immediately. However, the a balance 50% of the bank borrowing, which is linked to MCLR, we're not seeing banks aggressively reducing the rates in line with the repo rate cuts. For example, repo rate cuts happened around 125 basis points over the last few quarters. However, this has not translated into similar numbers. While banks have reduced the rates, but it has not been, even 50% of the reduction, which of the 125 basis points that has happened on the MCLR. So, to the extent of the MCLR related borrowings, we will not see much savings.
Okay, thank you so much, Mr. Selvan, for coming in and speaking with us with regard to, of course, your numbers. But let's switch focus back to the budget. Ashish Kumar Chauhan and Sundaram Ramamurthy. Sundaram